Tax season. That time of year, right? For a lot of us, it can bring on this wave of stress, all these forms, rules, deadlines. But you know what? It really doesn't have to be that complicated. In the next few minutes, we're going to break down exactly what you need to know so you can file your Indian income tax return feeling totally confident. So, let me ask you, feeling prepared? It's a simple question, but if your answer is a hesitant, not really. Trust me, you are not alone. So let's change that right here, right now. We're going to swap that anxiety for some clarity, one simple step at a time. First things first, what even is a return of income? The easiest way to think of it is like your annual financial report card that you send to the government. It's a formal document where you just lay everything out. Here's what I earned, here's what I saved, and here's the tax I owe. It's the foundation for this whole thing. And here's our game plan for today. We'll start with the biggest question. Do you even need to file? Then we'll figure out the exact form you need. After that, we'll cover those all-important deadlines, see what happens if you're late, and wrap it all up with a quick guide to something called TDS. Sound good? Let's go. All right, let's dive right in. Who actually has to file a tax return? This isn't just a suggestion, it's the law, specifically Section 139(1) of the Income Tax Act, and the rules are very clear. So the rule is pretty straightforward. If you're running a company or a firm, you have to file, period. It doesn't matter if you made a profit or a loss. For individuals like most of us, it becomes a must-do once your total income goes past that basic exemption limit. And listen up, if you're a resident with any assets overseas or you have signing power on a foreign bank account, you're on the list too. But hold on, it's not just about your income. You could also be required to file if you've made some big transactions. We're talking things like depositing over 1 crore rupees into current accounts, spending more than 2 lakh rupees on a trip abroad, or even having an electricity bill that tops 1 lakh for the year. And here's a big one. If you've had tax deducted and you want that money back as a refund, filing a return is the only way to get it. Okay, so you've figured out you need to file. Great. Now for step 2, choosing the right tool for the job. And that tool is your ITR form. I can't stress this enough. Getting this part right is absolutely crucial. Here's a simple way to think about it. ITR forms are like a set of keys. You wouldn't try to open your front door with your car key, would you? Well, it's the same idea here. The tax department has a specific key, a specific form, for every type of financial situation. Pick the wrong one, and you're just asking for trouble. So let's find your key. For most salaried folks with pretty simple finances, ITR1, also known as Sahaj, is your go-to. Easy. But if things get a bit more complex, say you have capital gains from stocks or you own a couple of houses, you'll need to level up to ITR2. Got income from a business or profession? That's ITR3. ITR4, or SUKAM, is for people using a simplified tax scheme for small businesses. And finally, Forms 5, 6, and 7. Those are for bigger players like firms, companies, and trusts. You've got your form. Awesome. Now let's talk about the clock, because it is ticking. Missing the deadline is probably the most common mistake people make, so let's make these dates impossible to forget. For most of us, individuals, and what's known as a Hindu undivided family, the big one, the main event, is July 31st. Got it? July 31st. Now, for companies and firms that need their books audited, you get a bit more time, until October 31st. And if you're dealing with international transactions, your deadline is even later, November 30th. Go ahead, put in your calendar right now. But hey, life happens, right? What if you miss that date? First, don't panic. There are definitely consequences, but there are also ways to fix it. So let's look at the penalties and, more importantly, your options. It's the question nobody wants to ask, but everyone needs to know the answer. What really happens if you just miss it? Well, it's not just a slap on the wrist. It comes with a real, direct financial cost. We're talking about a late filing fee that under Section 234F can go all the way up to 10,000 rupees. Ouch. Now, there is a little bit of relief. If your total income is under 5 lakh rupees, the penalty is a lot lower, capped at 1,000. But still, that's money that's way better off in your pocket, not the government's. So what are your lifelines here? First, you have the belated return. This is what you file if you just missed the deadline completely. You have until December 31st to get it in. Next is the revised return. This is for when you did file on time, but then you realized, oops, I made a mistake. You have until December 31st to fix it. And finally, there's a newer option called the updated return, which lets you correct things for up to 2 years as long as you're paying more tax. Okay, final section. Let's quickly demystify something you've probably seen on your payslip or your bank interest statements a million times. Those three little letters, TDS. Understanding this is really key to seeing your whole tax picture clearly. TDS, or tax deducted at source, is basically a pay-as-you-earn system. Instead of you getting a giant tax bill at the end of the year, the person who's paying you, whether it's your boss or your bank, cuts out a small slice of tax from each payment and sends it straight to the government on your behalf. It's kind of like paying your taxes in installments.
Now, for anyone who's actually doing the deducting, they're called the deductor, there's a piece of ID that is an absolute must-have. It's called a TAN, or Tax Deduction Account Number. This 10-digit number is totally non-negotiable for them.
So, what's the big deal? What happens if a business is supposed to be deducting tax, but they just don't get a TAN? Or maybe they get one, but forget to put it on the paperwork. Well, let's just say the government takes this very, very seriously.
Yep, there it is again, a flat penalty of 10,000 rupees. The law, Section 272BB, is crystal clear on this. If your job is to deduct tax, you must get a TAN and you must quote it. It's really that simple.
You know, at the end of the day, TDS isn't just about making your life a bit easier at tax time. It serves a really big purpose. It gives the government a steady, predictable flow of money all year long, and it helps make sure more people are part of the tax system. And there you have it. We've gone through who has to file, which form you need, when the deadlines are, and even how TDS works. The rules aren't some big, scary mystery anymore. You've got the playbook. So the only real question left is, are you ready to use it and take control of your taxes?